I think in the last mortgage crisis, my law office did probably 500 workouts and then loan modifications, whether it was strip malls, homes, all sorts of asset classes. And those people desperately, needed money, couldn't find it. We had a lot of workouts, but you don't want to be in that place. You don't want to be in a place where you can't get money and you need it, or you don't have the ability to seize an opportunity that can change the whole table.
You're listening to the Rich State of Mind Show, the podcast made to make you the total package in the entrepreneurial world and give you what we call a rich state of mind. If you are here looking to learn about real estate investing, marketing, elevating your business, and developing your mindset to get to the next level, then you are at the right place. Stay tuned and be sure to join our community on richstateofmind.com. Now here's your host, Anthony Ritchie.
Hey everybody, welcome back to another episode of Rich State of Mind, where I'm talking to Seth Hicks. Seth is the COO at PrivateBankingStrategies, a wizard when it comes to growing wealth. He's here to educate us on how to launch into an entirely different realm of wealth without working hard. His team at PrivateBankingStrategies has established themselves as the leaders in the industry, bringing over 100 years of collective experience to help people achieve and keep financial freedom through private banking. They have helped countless businesses, families, and individuals achieve things they've never thought were possible. Definitely an episode I've been looking forward to present. I love the private banking strategy. I think it's a hidden gem that I want more and more people to know. And so I hope this episode is a wealth of information for you. So as always, thank you for listening and please enjoy. Hey, Seth Hicks, thanks for taking the time this evening on the Rich State of Mind podcast. Really appreciate you being here on a topic that definitely needs to be discussed. So if you could please just tell us a little bit about yourself and what you do.
Absolutely. Thank you for having me, Anthony. Well, I'm a 25-year commercial and transactional attorney that's been helping people keep what they make and effectively protect their assets and structure transactions in a way that it helps them keep their wealth and avoid unnecessary attack on the asset, maintain their financial privacy, take advantage of tax laws that are already in the books that the rich and famous have been using for literally hundreds of years, and effectively be able to use the same dollar more than once. And this is where people go, how do I use the same dollar more than once? And so we show people how to do that and create what's called the velocity of money. And especially when you've got something like real estate assets or crypto assets, and you're able to put your money to work and create an ROI, the velocity of money really picks up. So those are just a few of the targets that we hit. But people that want to keep their assets private, or they want to protect their assets, they want to grow their wealth, they want to pay as little tax as possible. And they want to effectively, be as free of government control that they can be, then they're talking to the right person.
All those things, I'm pretty sure that when people hear this episode, their ears open, like, oh, okay, what is he talking about? I need to know more. Because the last thing I think people want is all the hard work that they put in, it goes away in a flash from a situation that maybe could have prevented or maybe it couldn't have.
I'll tell you a story real quick, Anthony. This is a story about a friend of mine who I grew up with. He's a very wealthy man now. He has a company that does 10 million gross annually in the northern Texas area, and he's a contractor and a roofing coach. A brilliant guy. But there was a time when he was absolutely dead broke and busted, and the bank effectively wiped out all of his cash in his accounts. He had construction loans. He was blowing and going, building construction homes, and had a contractor that stole the piggy bank, so to speak, and left all the subs unpaid, left the mortgages unpaid. And so the bank came to him because he was on all of the construction financing, and he happened to bank uh, personally at the same bank. So once that they had obtained judgments and foreclosed on properties, they drained his personal bank accounts. And he woke up one morning and realized that he had no money. And it was a surprise. He didn't even realize what was going on behind the scenes. He kind of had the ostrich syndrome where stuck his head in the sand. Anyway, he had to get a job as a limo driver, and he was driving people back and forth to DFW airport at all times of the evening and the morning. And it was a very, very rough time before he was able to crawl back out. And the point of what I wanted to get at is, like I said, I've been friends with him since we were teenagers, and I would tell him about asset protection. He was like, yeah, man, I'll get to it, and he didn't really see the purpose in it until he got smashed right in the face and he couldn't see straight. And then after that, he realized, wow, I need to consider asset protection so that I can keep what I make. And as he's climbed the ladder back up, he's, like I said, a very sharp guy, entrepreneurially minded, smart man. And he's focused on asset protection and keeping what he makes. So there's maybe folks out there going, maybe, I've never been sued. He was sued a matter, I think it's 7 times now. And most of these things are real estate related. And if you're in real estate out there listening, you don't always have to be at fault to have a tenant sue you for no reason or for any type of other thing that you might experience. Real estate investors are about 10 times more likely to be sued than another type of investor. So just a quick story about asset protection matters to everybody. And you really need to plan ahead before you need it so that it's in place before you have the problem.
Yes. And so, asset protection was just one pillar out of the 7 pillars of the private banking strategies that you discuss. For the second one, tax-free growth, how is this possible?
Well, Internal Revenue Code 7702. If you're taking notes, take a look at Internal Revenue Code 7702. What it does is it carves out certain assets that are able to grow tax-free, and there's no reporting on those assets. When you fund a private bank, we use whole life insurance, a properly structured and crafted whole life insurance policy. And these policies are carved out by Internal Revenue Code 7702 as not being taxable. So when you fund your policy with $100,000, the insurance company doesn't raise its hand and tell the IRS what you funded or what you haven't funded. And when you pull cash out of your policy, which is one of the great benefits of this, you can put cash in and take cash out. That's why we treat it's like a bank. It's not Wells Fargo. It's not Bank of America. It's your own bank through a life insurance policy, which has no tax event. So unlike if you go down to Wells Fargo or Bank of America and you have larger transactions, or try to pull $10,000 out of your account or deposit $10,000 in cash, they have to file forms that report the transaction to the IRS. It's part of their duty under the law. Well, life insurance companies don't have to do that, and there's no taxable event. So the growth comes from when you fund your policy. Year after year, you've got a compounding tax-free growth. And some people will go, well, is that kind of like a 401k? Yeah, except that there's no tax when you take it out. There's no penalty if you take money out. You can take money out in 2 weeks after you fund your policy. You don't have to wait till you're 70, and you don't have to do it before you're a certain age. And there's literally no tax issue on it. So that's one of the tax-free growth aspects of this.
So when it comes to whole life, my understanding was that you have to wait for it to mature before you could take money out of it.
No, not with the structured properly whole life insurance plan. We're talking 2 weeks. So if you put a cash premium on an annual basis, you have a certain percentage of that you can pull out in cash value year one. And there is, you're paying for insurance. So if you happen to die the next day, and let's say it's someone like yourself that's young, healthy, the death benefit is going to be pretty robust. And so there you're paying for some insurance, and there is some lag there, so to speak. But the year two, you get actually more cash value. Year three, you get even more cash value. Year four, year five, year six, you're actually getting $1 plus for every dollar you put in. So it starts to balance out rather quickly as far as your cash value goes. And for example, let's say that you have $100,000 annual premium. Your cash value that you can pull out would be somewhere between $60,000 and $70,000 in cash value that you can pull right back out and put to work in the first 2 weeks of the policy. And so second year, you're going to have, we'll call it, you put in 100,000, another $100,000. You've got cash value that comes back out at 80, 85,000, and so on. Year three, it increases more. Year four, it's pretty much dollar for dollar. Year five, it goes to dollar plus. And so you're effectively able to get more cash value for every dollar that you put in than you're actually putting in. So think of it like creating a new business. Any new business and thing has an expected runway before you're going to make a profit. I mean, I don't know how many new businesses that you've launched. I've launched a number of them. There's some drag on the front side. Well, you're creating your own bank with this system, and you're not going to get 100% profitability right out of the gate. But after year four, year five, you are. Does that make sense?
No, it does. And you got it working both ways for you as a bank and as your life insurance policy as well.
Yeah, we don't solve for the death benefit. Like, that's not a primary focus, but yeah, you're exactly right. You've got that aspect of the policy that is valuable. And let me just jump to tax-free transfer to heirs. It's the legacy value, seventh pillar of private banking strategies. We'll make a resource available for your audience so that they can pull down a sheet and see what we're talking about.
Awesome.
Legacy value, tax-free transfer to heirs. Let's say you've got this life insurance policy and you pass, and you've got it, a $20 million death benefit, or it doesn't matter whether it's 5 million, 10 million, 20 million. There's a tax-free transfer to your beneficiaries, your wife, your children, your charity, whomever you've intended that for. The beneficiaries are going to receive that tax-free. Now, let me compare that and contrast it with someone most people have heard of and know of. It's the artist formerly known as Prince. Well, he passed away not too long ago, and he was worth about $200 million when he passed away. And of the $200 million estate, his home residency was in Minnesota. And between the state of Minnesota and the IRS, they took over $100 million of his estate. So his beneficiaries and heirs were left with less than 50% of what he had made and earned over his lifetime. Whereas if he would have been in a properly structured transaction for legacy wealth, including a whole life insurance, he would have avoided tens of millions, if not the entire amount. And it serves as a good reminder to, structure things ahead of time. I mean, some people think, well, I'm not going to be here. Well, it's pretty selfish to think that way. I would want my wife, my kids to have what I've earned.
Yeah.
Or no matter whom it is, that I'd want them to have what I earned and not be going to, the IRS or any state government or any government agency. I think most people feel like that.
Yes, I would want that as well. I mean, I know I would have a few jokes from my family. Like, if you're watching this video, I'm probably not alive, but I would generally want them to be well off and not to bicker. I've seen money really destroy family relationships. And I think the best way you can help facilitate that is to set things up if you unexpectedly or expectedly pass. So I think you're absolutely right.
And you certainly don't want Uncle Sam taking half of your wealth, right?
That's crazy. That's a lot. So for pillar number 3, we have financial privacy. Never heard of that before. What is that?
So financial privacy is keeping your financial footprint as small or non-existent as possible. And it kind of goes back in some ways to what I was talking about when if you bank at Wells Fargo or Bank of America or Chase, and you go down and you try to deposit $10,000 in cash in the bank account or take $10,000 out, they raise their hand and they actually have reporting that's required with cash transactions. Or I don't know if you've ever tried to wire a large sum of money from one place to the next, and they ask you, well, what's your business? What's the purpose of the wire? Why are you doing this? And they go through all these questions to try to vet, who you are, what your business is, why the money's moving. And all of those things are really unnecessary. And so with private banking strategies and a structure that's set up, that the life insurance company they don't file any reports. They don't ask you any questions about when you're pulling your money back out. Why are you pulling the money out? What's your business? None of those things are a part of the process. And they're effectively not an agent of the government like your centralized banks are. They're literally commissioned to garner information from their depositors and report on them. And people are starting to clue into this stuff. Things like the Dodd-Frank Act, and folks can go out there and do some research on the internet about the Dodd-Frank Act. It's called the Consumer Protection Act. It's anything but consumer protection. It's actually the Consumer Fleecing Act. And what it says is that banks can bail in on deposits, and that the deposits that you keep in their bank are not really yours. It's the bank's, and your bank statement is an IOU. And people are probably shaking their head going, man, what is this guy talking about? He's crazy. It's not crazy. And so go check it out, man. Read about the Dodd-Frank Act, and it will explain to you that the money you deposit into Wells Fargo and Chase and Bank of America and all the big box banks, you sign their agreements, and it is subject to the Dodd-Frank Act passed in 2012. And your deposits are actually their money. And in the event that they become insolvent and unable to pay all of their depositors, they're able to bail in on those deposits to make themselves solvent. And that means that you don't get paid. And so the next thing that people say, well, what about FDIC insurance? What about that $250,000 guarantee I've got? Well, Harvard economist, we write about this, and I've got blogs on our website, and you can just Google it. Harvard economist lays this out. The FDIC is insolvent to pay all of the depositors that it's guaranteeing to pay. It's got 1.3 cents per dollar insolvency. So let's say you got, $100,000 in the bank account, and your bank goes belly up, and they say, sorry, we don't have anything. So you make a claim on this FDIC insurance, and they pay you 1.3 cents per dollar on your 100,000. You're going to like that? No. But that is the hard reality. And so I'm simply relaying information. I didn't create this information. I'm relaying this. And if you want to take yourself out of the normal banking system, you want to take yourself into a realm of financial privacy, you need to set up, a private bank, and you need to set up a structure where you're in control and the bank isn't in control.
So you mentioning this reminds me of what's happening in China right now, where people can't take their money out. It's been happening for a few months now.
Well, and it's happened in the past. You've got Cyprus in Europe, where they effectively bailed in on their depositors, and folks who had over $100,000 lost 50% of their account. So you got $1 million in there. First 100,000 was yours, and then the other 900, they took 50% of it. And there's still litigation going on right now of depositors trying to recover money, but they won't. So they tested this system. When I say they, I mean centralized banks. They tested the ability to bail in on depositors' money in
Mhm.
Europe, and almost every country in Europe has enacted legislation that allows bail-ins, and America did the same. And but if you asked 100 people on the street, hey, did you know that your deposits in your bank account are not really yours? They'd go, you're crazy. I
Yeah.
mean, maybe maybe one person might say, yeah, I realize that or something, but most likely not.
So you recommend people strictly use their well-structured life insurance policy as their bank and take their money out of the banks.
I absolutely do. I recommend that folks diversify their wealth into ways that they control those assets. And so we're proponents of precious metals. I mean, we have a large crypto clientele. Some people feel crypto is super, speculative. It's too speculative for some. We've had multiple minted millionaires out of crypto over the past 5 years that diversify among crypto, real estate, private banking, other hard assets and commodities, which they can control, and that don't leave them subject to being pillaged in a centralized bank. Now, we use centralized banks for convenience, meaning effectively for convenience only. So you don't leave a lot of money sitting there, but they make things convenient for a reason. But to answer your question, yes, we believe that a properly structured whole life insurance policy or policies that create your own private bank are part of a well-rounded financial structure to protect your assets and keep yourself protected.
I guess so. I would just use my banks to pay bills.
Right. Yes, that's exactly right. We call it a clearing account, so that your normal bank there is simply for typical payment transactions, and you've got the ease of doing that with online services and things that typically people are utilizing. I mean, a lot of folks don't even use checkbooks anymore. It's all online or ACH or ETF transfers, and they make their life easy and convenient with the touches. And so you would have a collection of your income streams pooling into a bank account. You pay your bills, and then you strip all the profit off and dump it into your private bank. And that's how the process goes every month. And but only for convenience.
Gotcha. Yeah, and I would imagine this would have to be something you guys stay really on top of. And so the way I do my budgets, I always have different accounts for different, roles. So like I'll have money set aside for like vacation, money set aside for bills and stuff like that. So I'm very curious, after you pay all your expenses and you dump all that money into the life insurance policy, how you can allocate and identify, okay, what money is what, because you do talk about diversification, but I guess it would just have to be a change in how you do business, and because what you're saying is definitely different, right? People are probably listening like, okay, this is completely different than what I've been doing for 20, 30 years, but it does provide a lot of security, and it's got me thinking about other ways that I could control my own money to make sure that if the banks do seize, I'm not on my butt with me and my family, and then we're not banging on the bank doors trying to get what, $1.15, 15 cents at a dollar. What did you say?
Yeah, that 1.3. Yeah,
Yeah,
1 cent,
yeah,
1 cent on the
$0.01.
dollar.
Sheesh.
But it's a good segue to pillar number 4 in the velocity of money, multiple touches on the dollar, and I will dovetail that with how you asset protect in the form of a real estate asset. So let's take an investment property, and I'm going to use round numbers and thing, $100,000 investment property. Let's say it's somewhere in the South. And let's say that spins off $1,000 in rent a month. Okay. So you've got $100,000 property and you've got $1,000 rent coming back, and you use your own private bank to purchase that property of $100,000. You've got a you're going to set out a full on loan transaction with a promissory note and a deed of trust or a mortgage, so that that property is fully encumbered by your private bank, and you treat the transaction just like any other bank would. They're going to get their money back. They're going to get paid on that. So you've put a dollar into your bank. You've pulled a dollar out of your bank to purchase a piece of real estate. And now you've got a dollar coming back to you in rental income, which then goes to pay PITI, principal, interest, taxes, and insurance. And then you pay that right back into your private bank. So you've got multiple touches on the same dollar that you originally used to fund the policy, make a loan to buy a piece of real estate, buy a piece of real estate that kicks back rental income to you, and then you're paying back your loan. And so it's like, you go, well, man, think about that for a second. A lot of times if you just spend money that comes into your possession, and you go pay a third party bank, when do you get to use it again? You're not getting to use it again. It's gone. It's in the bank's possession. And what do they do with that dollar? They actually create money out of thin air. It's called fractionalized banking, derivative lending, and they have the right and the ability to take a dollar of deposit and lend a multiple of that. So let's say they get $10 in deposit, they can lend 100. Did you know that? I mean, it's
Yep.
fractionalized lending, derivative banking, and it's one of the reasons we're in such hot water. But life insurance companies can't do that. They have to keep a $1 to $1 reserve on their deposits, and that's why they're much more financially healthy. That's why they've been around for over 200 years. They always pay dividends through the Civil War, through the Great Depression, through the last economic recession in 2007 and 2008. None of them missed a beat. But I want to take that same example just for a moment and take the
Okay.
velocity of money. And instead of using your $100,000 to purchase one property, you could purchase 5 properties with leverage. So you're going to use third party banks, right? You're going to still obtain a loan from third party banks. You're going to put 20,000 down on 5 separate properties. So instead of owning one property, you're owning 5 properties. You still had that initial $100,000. It's just spread over 5 properties, and you're borrowing from the bank, from a third party bank, $80,000 per property. Okay, and you go, well, isn't that contradicting what you're saying? Well, just hear me out, because we're going to get somewhere fast.
All right.
So you got 5 properties now, but you have a first mortgage that you pay to, let's call it Wells Fargo, and
Mhm.
you've got a second mortgage that you pay to your own private family bank. It's an 80-20. Okay, and you still got that $1,000 a month in rental cash flow, but now you've got it times 5. So you got $5,000 coming a month rather than 1,000 a month. And you can take that $5,000, cycle it right back into your private bank, and your cash value goes up by 5,000 every time you make a payment. So every month, and let's just exclude all of the expenses and the insurance and the maintenance, just for the sake of the math problem, to keep it simple.
Yeah.
You got 5,000 a month coming in. You're paying your bank back $5,000 a month on the $100,000 that it originally deployed to buy those 5 properties. And you got an $80,000 loan on property 1, on property 2, on property 3, on property 4, and on property 5. Well, you got 60,000 back at the end of the first year. 12 months, 5,000 a month, that's 60,000 back in your bank. What you can do is you go buy the first mortgage on your first property. You buy 60,000 bucks of it out. So instead of owing 80,000 on it, you only owe 20. And just a few more months, 4 more months to be exact, you can take out that other $20,000 of the mortgage to Wells Fargo, and you own that property number 1 free and clear.
Yeah.
The only mortgage that exists now in property one is to your private family bank. And it's fully equity stripped on title. It's still, it's going to be fully encumbered. So it's
Yeah.
$100,000 value and you owe $100,000. It looks just the same, but you're going to be the only bank that has a mortgage interest against it. And then you rinse and repeat and go after property two, property three, property four, property five, until you've got all of those properties only encumbered by your private family bank. And you've got all the cash flow coming back to your private family bank, so that you've got to go acquire more real estate assets, and you're going to increase the size of your bank and rinse and repeat.
What's the minimum I need to have a type, or, whether it's a cash injection or minimum I need to have it within the policy for this to make sense? We talking
There,
20
there,
grand or?
there is no minimum. There really isn't. And it depends on where someone is with their own wealth strategy. I
Okay.
mean, we write policies, all sorts and sizes. I mean, we're writing multiple $100,000 policies, even up into the $1 million policies for some ultra wealthy, all the way down to $10,000 policies. So it depends on where someone is and what their intent is. There is no minimum, though.
That's good. That's good to know. Just so, anybody, I don't want anybody thinking like, okay, well, this sounds like I have to have 10 million before I could even get started, or maybe even 100,000 before I can get started. I have 10,000. Okay, cool. I could get started on this and start building it up. And by the time year 5, then maybe they'll have 100 grand in there, but at least they can get started.
And frankly, the younger that you are and the earlier that you start on this, uh, the better. And here's the reason why. It's number 5 in the pillars: guaranteed compounding, tax-free growth. Now, anybody who knows what compounding means understands the power of compounding interest. Albert Einstein called it the eighth wonder of the world. Did you know, Anthony, that you can take a penny and compound it by doubling it for 30 days? And do you know what you come up with in 30 days? And
Is it 10 million?
it's $5 million. Good for
Okay.
you, man. Because I had an argument with my partner, man, and he was like, he said, compound a penny for 30 days and you come out with $5 million. And I said, man, no, you don't. So I started doing it in my head. And this is in the book that we wrote when we wanted to share secrets that banks don't want you to know, that you can get wealthy on. And one of them is compounding interest. So I started doing the math, and I'm like, a penny, 2 pennies, 4, 6, 4, 8, 16. I'm doing the math. I get to like, day 15, and we're only in the hundreds of dollars. And I'm like, man, you're crazy. And he's like, just keep doing the math. And so I kept doing the math. And by about day 24, 25, the light bulb came on. I'm like, oh man, we're going to, and then day 30, you're at $5 million. Now, obviously an investment doesn't double every day, but it illustrates the value and of compounding interest. So that is something that you can't find everywhere, but you can find in private banking. And with these life insurance policies, you've got compounding, tax-free growth. And unlike a stock market, there is no risk. So folks are, going nutty right now with the stock market volatility. They're seeing their retirement plans ebb and flow, and they're getting, they're getting shaky. It's great when they're going up, but when it starts to get volatile and go down, they're getting concerned, and they should, because you don't want any risk in your retirement. I mean, think about that. You're trying to build a nest egg, and it's not something that should be speculative or like going to Vegas. It should be something that's certain, that you can plan on, that you know exactly where you're going to be and exactly how much you need, when you want to retire. And so this is something that allows people to plan with that specificity, and you don't have any risk. Your investment's never going backwards. You're not going to have less money. You're going to only grow and compound. And the more ways that you can find to use that dollar more than once, like we described in the real estate transactions, the more it's going to multiply and the larger your bank's going to grow.
So would you recommend that people dump their 401ks and then dump it into their policies?
Now you're going to get me stepping on people's toes, aren't you? Absolutely. Absolutely. And here's the reason why, because you've got access to the money now. And if you can put it to work for yourself now, and you've got the compounding tax-free growth, you're going to far outperform what your IRA or your 403B or your other government sponsored plan will do. And we've got numbers that illustrate that and demonstrate that. And here's another thing. You can't touch that money until you're 70. And if you don't pull it out by the time you're 74, 75, you're getting penalized. So you want to take it
Oh,
out
wow.
early, you get penalized. You would take it out too late, you're getting penalized. And you're going to pay taxes on it no matter what, whenever you take it out. So take, 20% to a third and of that value and count it as not yours. It's not all yours. People make that mistake. I got $500,000 in my IRA. No, you don't. No, you don't. You have 300,000 because you're going to pay taxes. And do you think taxes are going up or down in the
Definitely up.
future? They're going to be going up. That's exactly right. They're going up and they're going to keep going up. And so your 401k and your government sponsored plan is going to be worth less in the future than it is now. I don't want to give the government that type of control and hand in my pocket. So I can do better than them, and I can keep my money moving and circulating and growing without any tax issue with inside and outside of my policies. That throws some people for a loop, for sure.
Oh yeah, I mean, because in the military we have our version of the 401k is the TSP Thrift Savings Plan, and people believe heavily into it. Some people have become millionaires from it as well, but I do like flexibility. I had to take a TSP loan one time to invest in a property, and I don't like asking other people for money. I hate the process. I'm in underwriting right now for a franchise. And I hate financing. I hate going through the financing process, the underwriting, the looking at my income, looking at how much child support I pay, like everything, when my grandma died. It's just everything they wanted. It's very intrusive, I would say. And I think it slows things up. I'm waiting 45, 60 days before I can actually get started what I want to do. Which segues us into number 6, which is guaranteed financing for the pillars. So what do you
Absolutely.
have to say about that?
You have no application. You've got no one asking you questions, no one digging into what you do, where you're going with the money. You don't have to create a business plan. You don't have to qualify. All you have to do is say, send me my money here, wire it here. And so that's the difference. There's no loan application process. There's nobody asking you about your assets, your cash flow, anything. Now, that compared to being denied financing, especially if you're involved in a business and you need credit to for some reason. In the COVID shutdowns, you lost cash flow and you needed to tap into money, and you try to go get an SBA loan. Forget it. It's not happening, and that crippled a lot of small business owners, especially in retail and in the food services and restaurants. I mean, they were absolutely crushed, and if you've got the ability to tap into guaranteed financing, it's there. Now, let me just drop some knowledge here on folks. Did you know that Ray Kroc with McDonald's, that he started McDonald's with private banking? J.C. Penney's. You've got, the list goes on and on. JF Kennedy, Nixon. You've got all of these politically elite, super wealthy folks that utilized private banking and whole life insurance to fund their businesses, to start their businesses, to expand their businesses, to run presidential campaigns without any questions asked. And it was one of the primary foundational reasons that some of them had success. But the list goes on. I mean, there's a lot of folks out there that are household names that people wouldn't necessarily know. They use private banking instead of some other type of financing. But if you've ever been out there, folks, who and been stuck in the middle of trying to get financing and really needing it, that's that's when you have problems. I think in the last mortgage crisis, my law office did probably 500 workouts and then loan modifications, whether it was strip malls, homes, all sorts of asset classes, and those people desperately, needed money, couldn't find it. We had a lot of workouts, but you don't want to be in that place. You don't want to be in a place where you can't get money and you need it, or you don't have the ability to seize an opportunity that can change the whole table.
No, you're absolutely right. And I really hope as people have listened to this, their brain is trained like mine is on ways that they could strategize what they're doing financially and just, mentally just kind of change what you thought was status quo, or what is status quo and adjust to what best fits you and your business down in the long run and your family, more importantly. Um, because I tell you, we break our backs, becoming a millionaire, being an investor, being a successful individual is not easy. And the last thing we want is for things to either get in our way or for things to set us back. So number 6 is a big one for me. And get financing. I hate going through that process. Even tons of paperwork, tons of scanning, calling, explaining. So yeah, that would definitely be me. I'd be so happy. Oh, I need 50,000. Oh, I'm just gonna talk to my insurance and they'll get it to me in a couple of days.
Exactly. Makes a big difference.
So what I always like to ask everybody that comes in this show is their rich state of mind. What is your rich state of mind? What's your big why? Why did you get into this field, and why do you have been doing it for 25 years?
Well, practicing law was something that I originally had a passion for trial litigation. And so
Mhm.
I've done trial work and also transactional work, and both in multiple states. And uh, I don't know that there was necessarily a passion other than it was just very rewarding, helping people and helping them structure transactions and then helping them resolve issues. But when I found the private banking strategies and my partner Vance Lowe, my head was flipped upside down. I didn't know that anything existed out there like this, and was quite skeptical because I thought that I pretty much knew it all, having a pretty long expertise and experience in structuring transactions. And attorneys, I think, sometimes are narrowly myopic in that they think they know things they don't. Well, I didn't know even half of what I should have known about asset protection, wealth preservation. And so my partner Vance helped me to see the light and go, wow, there's a way to structure transactions. There's a way to protect your cash with the simple stroke of a pen by putting it in a private banking policy that does all of this work that you spent years thinking that you're something amazing to come up with some hard way to do something when there's something a lot easier that can be done and accomplish the same thing. So I love helping people protect their wealth. I love helping people grow their wealth. It's exciting to help folks, and some of our best clients are folks that have come from nothing and really put things to work for themselves and became very successful. And so there's a great reward in helping people accomplish their goals and their dreams, and being a part of that process. It's very fulfilling.
Yeah, I bet. Because you're changing lives. How can people reach you, Seth? How can people get in contact with you?
You can find us at privatebankingstrategies.com. That's privatebankingstrategies.com. And you're actually going to be given the opportunity to get our book about how to grow rich with the secrets banks don't want you to know. And that's kind of what we like to call a red pill book, which helps
Okay.
people spot issues, on what the bank does. And if you like that content, just keep on digging, man. We've got all sorts of resources that people can binge on. And if you got questions, just hit us up.
Awesome. Well, thank you so much, Seth, for your time. This has been a wealth of information, and I like how you have it to where people do well with like stages or phases or steps, so 7 pillars. This is actually, you know what? I need to make sure I get your book because I definitely want to read this and explain to my wife. Actually, when we get off of this, I'm going to be explaining to my wife, hey, look, I think I got an idea, because Seth gave me an idea of what we can do. So thank you so much, Seth. I think you've been a wealth of knowledge in the 45 minutes that we talked that I think is going to change a lot of lives.
My pleasure. And thank you for having me, Anthony. Be glad to help you and any of the audience. It's a rewarding thing. We take it as an honor and a delight.
Thank you for sticking with us from the start of the episode. Please share our show with friends and family, visit our YouTube channel, and view more of our content on richstateofmind.com. See you next week on the Rich State of Mind Show.